copyright next week. And now, our main speaker, Carlee Price. We're very happy to have Carlee here. She has spent 18 years in fiduciary roles on Wall Street. She started with the Deutsche Bank. She's been a top analyst with all of her firms. She's covered companies as large and complex as General Electric. As an analyst, she was recruited to a partner track role at an institutional fund management in Seattle. And unsurprisingly, having come to Seattle, she caught the entrepreneurial bug. Became a founder and has been now working on both sides of the table as an investor, as somebody who advises startups. We're extremely excited to have her. She has served as due diligence lead on a dozen seed stage deals. She really understands risks and rewards. She's a CFA charterholder. I'm told that's really, really cool, and I unfortunately don't know what it is, but it's really cool. And she is my favorite line in her bio. She is an avowed numbers nerd, and we're so happy to have her. Thank you so much, Carlee.
Can you all hear me okay? Is this thing on? Okay. So I want to, before I get started, just do a quick survey. How many folks in this room are founders, meaning you've been incorporated and you're starting to work towards a product launch? And how many are aspiring founders, meaning at some point you'd like to be raising your hand, but you're not there just yet? Cool. And the rest of you are just here for interest's sake. Maybe we have some also number nerds in the room. So we're going to talk today mostly about how numbers can exist with your business model. So I like to describe it as a language. So numbers are a language the same way English is, the same way anything else is. The more fluent you can become around the numbers that are part of your business, the better able you'll be to communicate with investors, to make rational decisions around your business, to improve profits, and to really drive insights into what's happening with your business. So numbers are a language. You need to use it. You need to learn it. It really does imbue every part of your operating business. Now, first, before we can even talk about numbers, we have to blow up some myths about finance. A lot of people are dismissive of finance. So I don't need to have forecasts because forecasts are fantasy and the reality is always going to be quite different than what I write down on a sheet of paper. Doesn't mean you can ignore them. I don't trust money people. Vulture capitalists. Who's ever heard of the term vulture capitalists, right? So it's easy to be dismissive of this when in reality it is a very important part of your business. You're also very busy people by the time you get around to founding a company. So make the time to allocate effort and time and resources to this category, and you'll benefit. So when we talk about finance, let's set the stage. What exactly are we talking about? What are the functional pieces, right? So finance can include bookkeeping and accounting. These are the folks who make accurate records of what your business is accomplishing and then report those out. This is the one non-optional piece of the finance function. So the minute you're in business, you're going to need to report to government agencies what your revenues are, what your income is, and that's the role of a bookkeeper and an accountant. Another piece is controllership and treasury. This is the function that tells you how much cash you have. It's exclusively focused on what the balance sheet looks like. Now, if your controllership is a function of opening up your bank statement and hoping for the best, you're doing this wrong. So as soon as you're in business, you're going to want to take care of these two functions. These are not what we're going to talk about today. What we're going to talk about today are the final two pieces, financial planning and analysis and business intelligence. So this is built atop of the bookkeeping and accounting function, but is focused on forward-looking conclusions as opposed to backward-looking reports. So it's really about driving decision-making and using the numbers that are produced by your bookkeeper or accountant, as well as the numbers that are produced within the functional departments of your business to make good decisions. And that's the scope of what we'll be covering today. So what are the actual deliverables here? What sorts of things can you expect to bubble out of this sort of effort? And I've laid out here sort of a progression of what types of functions you might undertake in this particular subject. So from the very beginning, you're dealing with a record of revenues. This is something that any business would have. This could be the point of sale in a small shop. So what have I sold today? This is sort of the very simplest, most basic, most necessary report that'll come out of your finance function. and then increasing in complexity all the way down to capital allocation optimization. Now, what on earth is that? That's a function of taking the money that's generated by your business and reinvesting it in a mathematically optimized way. Now, this is way down the road. This is for companies, and she'd mentioned GE earlier. These are for big, large public companies. You can do this on a smaller scale, but don't expect that you're going to jump from record of revenues all the way down to capital allocation optimization. There are plenty of places, plenty of beautiful places to visit along the way, and that's what we're going to be talking about today. So your needs will also change not only with the knowledge that you build and the skills that you build, but also with the stage of your company. Where is your company in the life cycle? So for these purposes, I've broken it down into 5 stages. Everything from pre-revenue all the way up to exit. Now what you're going to need and the reports you're going to produce are going to be different, and we'll get into that shortly. So pre-revenue, how many parents do we have in the room? A couple parents. So you remember before you have a baby, you spend a ton of time preparing the room. You're going to take the diapers out of the little box and put them in the drawer. You're going to do a test run to the hospital. And you do all this because you know that when the baby comes, the crap's going to hit the fan and there's not going to be any time to do anything. Okay? So the pre-revenue phase of a startup company is the same. You want to do as much as you can ahead of time so that when you're in market, when customers start knocking on your door, when you start moving product, a lot of this stuff has been taken care of. Now you may think, I don't have any numbers, so how am I going to do any financial analysis? And the answer is that you want to be looking at your forecasts and using those forecasts to drive the insights and the structure to answer those questions even before you have $1 of revenue. Once you've got a forecast laid out, once you've been able to focus on what the important pieces of the business are as you imagine it, because again, you're not in business yet, this forms the foundation for doing things like customer validation. You're going to de-risk. You're not going to have actual numbers, you'll have a range, but part of your job in this stage of growth is to narrow that range down and to increase the confidence you have in the assumptions that you've made. You're also going to learn about the cash mechanics of your business, which is how money will flow in and out. And you're also going to do, hopefully, some gating. Now, what's gating? Gating is setting out ahead of time what are the metrics you need to see before you move to the next stage. So as a pre-revenue founder, you want to test your business model sufficiently that you are confident that investing that next $50,000, investing that next $100,000 is a smart move. You don't want to decide this in the moment because passion will take over, and you're going to talk about passion next week. And you really want to be very methodical and very deliberate about gating the next investment stage for your company. So let's get into the mechanics. So here we've got a very simple forecast. And as I mentioned, forecasts are going to be the focus of your attention in the pre-revenue stage. Now the good news is that because you don't yet have any reported numbers, you get to make up whatever you want on this sheet. It's very liberating. So really you start with a blank, literally a blank page. Your ultimate forecast will hopefully be more complicated than this, but this gives you a sense. You're looking for roughly an income statement type report, sales, COGS, net profit. And again, these are just the numbers that you choose to begin with. But you'll notice, if we blow this sheet up, that there's actually only 2 hard-coded numbers on that sheet. Everything else is a formula. And where there's a formula, there's an assumption. So as you build this sheet, as you build your forecast, be very mindful of what the assumptions are that you're making underneath those made-up numbers. In fact, the best thing to do is to pull those, let's see if I can get pull those numbers right out, right? So take your assumptions, which again are embedded in the sheet, and set them aside in a different table. This is where you want to focus your time and energy. So here, for example, I've chosen 50% target top line growth. So you'll see the 50% there, and then you'll see it reflected up here. Now, in order to get 50% top line growth, what does that imply for my variable expenses? How much money do I need to spend on marketing to bring that many customers in the door? And that's another assumption here. So I've assumed that for every $5 I spend in marketing, I generate $1 of sales. So by increasing my marketing spend, my variable expense, by 50%, I can see that 50% growth on the top line. You can't just put a number up there and have no foundation for it. This is really about driving down to what the actual foundation is and getting that. In this case, it's a 5%. We've also made assumptions around gross profit. I've assumed a margin of 25%. Again, all of these numbers will need to be tested. And once you get into the market, they will still continue to change. But be aware of them. Be aware of how differences in these numbers drive differences in the outcome, and just really get to know this piece extremely well. And just a quick aside, the reason I chose the sales piece and this marketing piece here is because this is the single most common mistake made by startup founders, is not tying that revenue number back to some sort of realistically based driver. If any of you know Dave Parker, who runs 6 Month Startup, anyone know him? Okay, so he does a lot of this work, and one of the things he focuses a lot of his time on is talking about driving sales and what are the different ways in which you can drive sales. Word of mouth, paid advertising, unpaid advertising. One of the categories he uses as well is called miracles. So any number on your revenue line that's not actively supported by some amount of spending or one of those drivers is coming through in the form of a miracle, and you need to get rid of that. So we've done all our pre-revenue growth. We're time to go to market. This is a very exciting time. This is when you start to get money in the door, not just money out the door. And it's time to start making some decisions. At this phase of growth for your company, the decisions you're going to be faced with are around your systems. So how do sales show up in your business? Are you using things like Shopify? Are you sending out paper invoices? Do you collect money through credit cards, through checks? Do you go to the bank and make a deposit? All of these decisions that you make in those earliest days are a little bit sticky, so you want to put some thought into it. You're also going to bring that bookkeeper we discussed on board, have a real honest conversation with him or her about how they're accounting for. So they'll set up a statement of accounts in your accounting software, and there's no time like that very first sales period to understand how it is they've set up that statement of accounts so that when those reports start coming out, you can really understand them. You'll also start down that fabled capital allocation road that we talked about. So every dollar that comes into your business is potentially some amount of money that you can then allocate to the growth of the business as well. Now, knowing how much of the money that's coming in is able to be spent is the second biggest question that you'll face in these early days. So you've received some money from a customer for whatever. You can't then go out, let's say you get $10, you can't then go out and spend all $10. You need to know how much of that is really free money to circulate back into the business, especially in the early days. Here as well, we're going to be doing more validations. So in the pre-revenue phase, we identified our assumptions, we went out into the market, we talked to customers, we tried to get sort of a theoretical sense of what was happening around our spending, around our costs, around the marketing return, all those things. Now that we're actually in market, you're going to start to get even more relevant and a greater quantity of feedback on those same assumptions. So consider this to be sort of an extended period of customer test and validation. Every data point that you get from a customer, you want to be integrating that and adjusting your assumptions on that basis. And then we're going to do some gating here as well. So I talked about how you should not be putting more money into the business until you see the results from your tests that approve that next level of spending. The same thing is going to happen here. The most important gating mechanism for early stage companies is stability in assumptions and repeatability of process, right? So once you start to see the dispersion around your assumption, your KPIs, your assumption metrics narrow down, and once you're confident that the process of spending, generating sales, that process is repeatable, that's the time to scale. It's easy enough to sort of rush through this early revenue period and start to raise money and start to think about deploying millions of dollars into your enterprise. But until you see the results from the business, that it's stable, that you can describe it, that you understand the mechanics of what's going on, it can be really dangerous to speed through this and get to the next stage. And then we'll just spend another minute on validation. Who knows about the central limit theorem? Oh, some statisticians, nice. And this is a really nice practical application. I promised that we'd have some fancy math in here for the numbers nerds, and this is it. So the idea behind the central limit theorem is that no matter what the distribution of your population is like, hopefully it's normal and very tidy, but even if you have distributions that are a little bit jaggedy or maybe more uniform than they are normally distributed, even with these strange looking distributions, if your sample size is sufficiently large, the average from repeated sampling of that sample population will approximate the population average, right? So this population average here is where our assumptions wash out. So this is the assumption that we can use in our model and confidently move forward to scale and grow the enterprise. So again, when you're starting to bring customers in the door, when the number of samples that you're taking starts to go up, you really want to pay attention, because what all of that information is telling you is where this peak on the distribution curve is. You might have a customer that costs 75 cents to bring in the door. You may have a customer that costs $28 to bring in the door. But if you get enough of these data points, eventually you'll be able to realize that it costs about $12, for example, to bring a customer in the door. So we've got some math. We've also got a little bit of statistics, and this is a vitally important part of the early stage of your company's growth. So now what? Now we get to scale. So we've passed all the hurdles. We've got our first revenues in the door. We understand our assumptions. They're starting to look pretty reasonable and pretty stable. Now what happens? So now is the time when you start to look for outside money or consider taking outside money. You start to speed up that machine. So if you were generating $100,000 in revenue, then maybe next month you're doing 150, next quarter you're doing 300,000. This is where things really start to happen. You want to continue in this phase to monitor your assumptions, right? Because we're still using forecasts this whole time. We started out, we had only forecasts. Now we've got a little bit of reality and still a lot of forecasts. So you want to stay on top of those numbers and make sure that they're reflecting what you're actually seeing in the market. So you want to keep monitoring those assumptions. You also want to be ready to react to change, right? So we talked about the central limit theorem and getting down to that very narrow point. But of course, the market is constantly changing. A great example is Google AdWords, right? So Google changes its algorithm 500 to 600 times per year, right? So even if you've optimized your SEO, even if you know that spending a certain amount on Google AdWords will return you a certain amount of interest into your sales funnel, that will inevitably change. I had another client whose competitor actually bought in a 1-week stretch all of their top Google AdWords, which meant that their outreach marketing went from pulling in about 12 qualified leads per week to 0. Had they not been watching this figure, had they not been watching their numbers, that reality might have gone unnoticed and might have cost them business. So as you're monitoring and as you're adjusting those assumptions, this gives you a real advantage in reacting to changes that happen outside the purview of your standalone company. You also get time here to think about velocity. So what is the velocity of a business? Does anyone know? Velocity. This is also any economists in the audience? No? Keep them out of the room. So velocity is just the rapidity with which money cycles through. So this is going to reflect your sales cycle. How long does it take from the initial outreach to a customer to when that customer actually gives you money for your product? And it also reflects how quickly you can then redeploy that capital back in your business. So I've set up 2 examples here. One is a 30-day cycle, so that's pretty quick. So that means that you spend $1 on marketing, which brings in 1/4 of a customer within 30 days, that they pay you right away, that you collect right away, and that you can redeploy that capital back into your business right away. Both of these, the 30-day cycle and the 60-day cycle, have the exact same margins, right? So you're looking at 30% profit margin, which is totally unrealistic, but it worked for the model. And again, a 5x return on marketing expense. So $5 of spending results in, $1 spending results in $5 of revenue. Other way around. And you'll see here that if you're on a 30-day cycle, so this $5 of spending fuels that $25 in revenue, which gives you $8 in profit, right, which is recycled right away into spending, right? So you can follow this down. So the 8 fuels the 38 to the 11. This is your 30-day cycle. Down here, you've got a 60-day cycle. So you're starting with the same $5 spending, but you're splitting it up over 2 months. This then feeds this number, which yields this number. And then this yields that number. The difference here, and the reason I want to spend time here, is because you'll see the difference in the growth rates. So a 30-day cycle is going to go exponential much more quickly than a 60-day cycle. The velocity of your business is important for this reason. And when you hear about the difference between a lifestyle company and a venture scale company, so you'll often be asked this question, are you building a company just to pay your bills, just to keep your cabin in the mountains afloat, whatever the case may be. If you're building that, that's going to be different. And one of the reasons it's going to be different is because the velocity is going to be different. Venture scale companies always have a good deal of ability to recycle, and they also tend to have very short horizons. This is also the reason why things like seasonal businesses are really difficult to grow. So if you can only make that decision twice a year, if you can only deploy capital and make decisions about pricing and things like that twice a year, you're going to be in big trouble. So something else to keep in mind when you scale up is how quickly can this scale reasonably happen. And then fundraising. Who enjoys fundraising? So fun. There will be a point in time, particularly if you have a venture scale business, where you need to go out and ask the market for some money. And the money, of course, is to fuel the fire that you've already established is part of a repeatable and stable process that makes your company grow. When you're fundraising, you need to make all sorts of considerations. Do you want debt or do you want equity? What are the implications of the equity you might raise? Who do you get the equity from? Of course, because you've done all of these steps and you know your numbers cold, raising equity is going to be very easy for you. But where to source it from? There's a couple groups in town that can help you out and all sorts of resources regarding pitches and things like this. But you want to be very mindful of that. And here again, we can use some financial analysis to help guide the way. So cap tables, we know them, we love them. One of the things that I find extremely useful, both as an investor and as an operator of smaller companies, is to do a long-range forecast for the cap table. And what we've done here is sort of set out these are sort of your iterations. So I'm going to raise pre-seed money that will last 18 months when I'll raise my seed, Series A, Series B. We all understand sort of the progression up the capital ladder and ultimately to exit. But the important piece, especially considering we're a room full of founders, is following your particular share of that pie as it grows, right? So this involves things like understanding the difference between pre-money and post-money valuation, right? This involves the difference between understanding dilution at various stages. So even though the share price is going up and the value of the company is going up, your net worth, the value of the stock that you hold, is going up by less because of dilution, right? So even setting aside the terms of the agreement, the 20% discount, is it a 5 million cap, is it a 6 million cap? All these decisions are vitally important and they can also be incorporated in here. But having the skills to be able to look into the future and to understand what's going on with the most important piece of this, which is your share over here, right, is important. And we do this both as investors, and we like to see founders do this as well, so that everybody has visibility into what's going on. You can go a step further and create sort of an internal rate of return over here, which is a little bit more applicable to the investor side. But this is a tool that you can use that will help you guide your decision when it comes time to raise money from outside groups. And then finally, exit. Who doesn't love a good exit? So by the time you reach the point of exit, you're going to have a ton of people who are very happy to help you out with all of this stuff. You'll have lawyers, you'll have bankers. You don't really need to worry at this stage about building spreadsheets to tell you what to do. You'll have highly compensated people to tell you what to do. But what I would say is that all of the steps along the way prior to exit, you do want to have a sense of what your company is worth. This is less about math and fancy spreadsheets than it is just about being aware of what's going on in your particular segment of the economy. Being able to do simple things like applying a multiple to your revenue or applying a multiple to your EBITDA to figure out what you might be worth. That way, anytime you are approached or anytime you feel you get sort of the spidey sense that someone might be sniffing around, you have a number in mind for what you might be willing to sell at that point in time for. I put DCF on here. Nobody uses DCFs anymore, but it's essentially just the bringing forward of, discounted cash flow. So discounted cash flow was in olden times when interest rates were non-zero, that you could actually determine the value of an enterprise by discounting the forward perpetual stream of income from that enterprise using interest rates back to value today. So essentially creating a bond type structure out of a company, but no one does that. Probably because no one has cash flow these days, but here we are. So exit is the final stage, obviously, where you'll need to be dealing with numbers. By this point, you will be an expert at all of these things. You will probably have a full-time CFO on staff, so don't worry about it too much, but just to keep in mind that this is sort of the long horizon goal that we're all working towards. So back to the math. So what do you need to do? What sort of skills do you need to have to execute all these different steps well? Are you in a position to even be building any of these things? What does it take? I'm going to tell you the math is incredibly simple. There's nothing in any of the financial forecasting lore that requires anything more than addition, subtraction, division, multiplication. You can get into some sort of compounding, discounting stuff, which is like powers and all sorts of things. But don't be intimidated by the math here. It's not complicated. We've all done spreadsheets. These are just spreadsheets that are very specifically focused on doing one thing well and hopefully coming together in a single point at some point. So the very, very basics, if you're just going to do one spreadsheet, and I hope that all of you rush out of this room at the end and go build your first spreadsheet. You want to do the very basics, subtotals. So as you have all of your categories for income and expenses, there's going to be a lot of them, and you do want that granularity, but you also want something that you can glance at quickly and that will make sense. So subtotals are your friends. You want the rows to collapse. You want to see what variable expenses are, for example, not like what your bank charges were that month. So you want to be able to total everything up and see sort of a high-level view in a single glance as you're building the detail in behind the scenes. Periodic growth is something we all love. So what were my revenues this period versus the same period a year ago? Am I happy with that number? Does that number need to be higher? That's a very simple division. And of course, margins, being able to cost things out and know what the percentage that you were then free to spend from every sale is going to be. Cash zero date, this is a big one. So always, 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 the second spreadsheet you build after you've run out of this room and build your first spreadsheet is your cash forecast, because this is the thing that's going to be your most important driver. The one thing that kills companies, you'll see a long list of things that kill companies, there's only one, and that's running out of cash. So if you have visibility into when your cash runs out, you can make all your decisions better. So simple spreadsheet, income statement, forecast, simple spreadsheet, cash flow forecast, you're going to cover 90% of what you need to know, especially in those early days. And then as far as the structure of this thing, there are a million templates you can find online. Again, it's really going to be a balancing act between complexity, which is well described here, and simplicity. So you want something you're going to be able to use. You want something that you're going to be able to glance at and understand what's going on. But you do also want to have a little bit of nuance. So I find this maybe a little bit too fancy, especially for early days. But start there, and then you want to create something from that that feels right for you. Everybody's different. This is why templates can be problematic. And then once you've built your first two spreadsheets, where can it go from there? There's all sorts of functionally specific spreadsheets that you can layer on top of your basic business outlook spreadsheet. So things like return on marketing spending. So I mentioned the 5X. So you spend $1 on marketing, you bring in $5 of revenue, right? You can create spreadsheets that will track individual campaigns, for example. So on this particular Facebook ad push, what did we return? You could schedule A/B testing and record that in a spreadsheet and help that to fuel your forecasts. Sales funnel. So what's your sales team producing? How many qualified leads? How many marketing qualified leads? What does the funnel look like, and what are the conversion rates? How are those changing? You can build out all sorts of individual spreadsheets for individual sections of your business. You always want to bring them back together to a single spot. So the sheet we saw earlier, you can have all of those functionally specific spreadsheets feed into this master sheet and use the master sheet to drive your business decisions. And then the methodology. So again, I started out talking about when you bring your accountant on and sitting down with him or her and having a conversation about how their workflow works, what the statement of accounts that you're going to end up spending a lot of time looking at really means. Understanding is the foundation of all of this. Even if you don't like numbers, just spend the time to get to know what's going on in yours, and you'll reap the benefits. Discipline and documentation. So as you start to create a workflow around these spreadsheets, around these forecasts, you're going to want to document it just in case someone else wants to step in and have a look. If it's someone wants to get in there and play around with the numbers, that you can sort of trace back and undo the work. So you want to have discipline, do it every month. Every month you want to roll things forward, or every quarter you want to roll things forward. Do it regularly, make it part of your practice. And then the documentation. And then these last 4 are sort of, I don't know what you call them. They're like good hygiene, so things that you want to keep in mind as part of each of these sheets. You want to ensure they're complete. So one of the things that happens a lot as well is you'll miss a certain type of revenue stream. So for example, you may sell things on Shopify, Amazon, and then you also have a booth at a farmer's market. Well, if you forget the farmer's market revenues, or if you're recording them in a way that doesn't get captured, that can really throw things off. Inventory accounting is another area that can often get lost. So really make sure that every dollar that flows into your business is accounted for and that you can follow, and this is formally known as an audit. You can follow that dollar through to your expenses, through to your profits, back through to the business. You really want a complete picture of what's going on and to not be missing things. Single source of truth. Another pitfall is oftentimes you'll see revenue in one place on a spreadsheet, and then you'll see a different tab over here that has revenue as well, but they're 2 different numbers. So as much as possible, you want a single source of truth for every important variable on your spreadsheet. If you need to repopulate revenue on a different tab, just create a cell reference. That way your sheets will be consistent across time and space, and when you use them, when you change them, the change will be automatically reflected. So try not to be repeating different cells. Version control, any computer programmers in here? GitHub, do we love GitHub, right? So GitHub, the whole point of it is version control and being able to go back in time and trace changes. You're probably not going to use GitHub for your financials, but if you can store at least quarterly the old sheet, it'll do 2 things. It'll provide a backup if anything should go wrong. It'll also allow you to go back in time and see what you were expecting versus what actually happened. Improving your forecasts over time, getting better at doing this is part of the goal as well. So having those historic outlooks can be really, really helpful. And then ownership. You want someone who's in charge of this. Could be the CEO, could be someone on the advisory board, could be someone on the team who just really enjoys spreadsheet work. But make sure someone's responsible for it. Oops. Oh no. So benefits, yay, everything's going to be great if you guys can do this. So really do try to make finance part of your practice, part of your language, part of every piece of your business. It's going to drive better decisions for you. It's not going to replace the intuition that you have as a founder, which remains vitally important, but it will help layer on a degree of accountability around it. So it's not going to make decisions for you, but it can help you achieve clarity around the decisions that you are going to have to make. The early warning system is invaluable, so know when that cash zero date is and have time to plan for it. Know when your marketing results have changed and have time to plan for it. Tremendously helpful. Makes reporting out to stakeholders much, much easier. Numbers people, investors love, love, love when you can talk numbers to them. And they really appreciate it when you're on top of your numbers, and they will shower you with money if you can do this well. And then, of course, higher valuations, ease of exit. Once it comes time where you're getting down the road and you might be a target for an acquisition, having all of your stuff in order, having a good conversation around what's been going on with the business, what's changed, invaluable, makes the whole thing much easier. So yeah, so join the team, do the financial footwork, start where you are. There's always room for improvement. There's always something more complicated or interesting you can do. And yeah, questions? Did I cover every possible thing? Yes, sir.
Yeah, when you're talking about scaling, you put up a slide that had some things on it, and you used the expression horizon.
Mm-hmm.
Don't understand the context for that.
What was the?
It was when you were talking about scaling.
Oh.
You had.
So we're talking about velocity?
Yeah.
Yeah.
30-day and 60-day, and then you said something about horizon.
Yeah. Okay. So. But I don't remember exactly, but a horizon, for example, can be, I'm raising money today, I've got 18 months of runway. By the time that 18 months is over, I need to have produced some sort of milestone, whether that's a total amount of revenue, whether that's a total amount of deliverable product. So oftentimes you'll have 2 goalposts like that, and you'll need to accomplish certain things between those 2. Now it's going to be easier if you have a higher growth rate, if you have that recycling happening. That was probably what I was talking about.
Okay.
Yeah. Other question? Yes.
Yeah, of course, sorry.
Oh, sorry. Yeah.
Oh, that's okay.
The first question was about Horizon.
First question about Horizon.
There you go.
This is a teeny tiny level question because I'm more of a lifestyle company than a venture. So I know talking to a lot of people that have startups, they don't really know when to start paying themselves
Yes.
and their people.
Yes.
So, and some people say 2 years and 5 years and this and that. And I'm like, okay, well, we're just teeny tiny and we just want to pay our bills. So like at what point is that really a realistic thing?
Yeah. So 2 things I'd say there. You want to price yourself into the model even if you're not actively paying yourself. So you want to create room in your forecast for that salary piece, even if it's not happening on a cash basis right away. The second answer to your question revolves around whether you're funding yourself or whether you're getting funding from outsiders. So if you're getting money from outsiders and if part of what you're planning to spend that money on is a salary for yourself, just prepare for some additional questions around there because you're essentially asking an investor to sponsor you, to pay your bills for some period of time, and they're going to have questions around what they're getting in return. But if you're a lifestyle business and you're not taking equity from outsiders, then it's really up to you. Yeah, just get it. Thank you. Anyone else?
Is it on? So when you're building that first spreadsheet,
Mm-hmm.
probably the most important part of that is your assumptions. And I mean, there's going to be a set of assumptions in there, and you can't build a set of assumptions without starting with the first one.
Yep.
And obviously you're going to have like a set of rough assumptions, and then you're going to have your first rest of, like you're going to start with some very rough assumptions and then try and close in on more exact ones. And I'm wondering, how do people even start, even putting together those first rough assumptions?
Yeah. So in my case, I just decided it was 50%. It can
the number halfway between 0 and
Yeah, it can be that simple. And the reality is, to your point, that it's going to change. So just start somewhere.
But there's got to be a source.
Yeah, just make it up.
That's the answer?
Yeah, because, and again, in that case, we started with a number, right? And then we had to create the spending. So I want my revenues to grow 50%. Okay, so now I need to create the spending that's going to allow revenues to grow. It's going to cause revenues to grow 50%. And that's an amount of spending. So maybe my constraint is that I don't have that much money. I only have 50,000 and not 100,000 to put into this business. So maybe that's the answer to your question. So I need to find the number that starts there, and then what sort of revenue can that generate? So there will be some constraint somewhere. I mean, you're not going to put $8 billion into some business that's not even started yet. So just think about the constraints that you have, and then maybe start there, or just start with whatever you like and end up there by working through and iterating the model. Yeah, or start with 50%. Good round number.
I'm wondering if you have advice on what help and expertise to bring in when, especially if you can't afford a CFO right away.
Yeah.
So just kind of how to stagger that.
Yeah. So, and I have another slide that I didn't include here, which is sort of the wasteland between when you hire your bookkeeper accountant, which is in the very early days, and when you're like Series C and have a full-time CFO. And that's really about parsing the work out to people on the team who may have an interest in it. So in most cases, the finance function will only be like maybe a quarter of a full-time equivalent for the first 5 years. So you either need to find somebody on the team who has an appetite for it and can do it well. There are fractional CFOs available on the market. I'm one of them. So it's possible to outsource the work the same way you would accounting or legal work or anything like that. But hopefully you've got somebody on the team who's got an affinity for it and can do that.
Another question about assumptions. If you are looking at making your first set of assumptions, are you going... That was my phone when I was like trying to get back to the question. when you're trying to make that first set of assumptions, is it going to be helpful to look at other people's models, or is it going to be distracting because you're going to get confused and just wind up using somebody else's model that has other?
Yeah, it can go
stuff
either
behind it.
way. So you kind of have to, it's just one of these know thyself sort of guidelines. So if you're looking at the other person's model to get particular numbers, like what is the return on marketing spend in this particular vertical, that can be helpful. But I wouldn't just download somebody else's complete model and run with it for that exact reason, that it can skew your view of your business, and you really need to create it specifically for yourself. Yeah, so it's a yes and no.
Yes. I went to a seminar at the headquarters, and it was about the slicing pie concept.
Oh, yeah.
So in the pre-funding period, are you familiar with people who've used this
Yes.
at that time, and would you recommend it? Or you
I
have other
would,
comments?
yeah. There's an online resource, and the name escapes me right now, but any tool you can use to divide up that first piece. So when I did the cap table forecast, it was with the assumption that there's just one founder, which is not going to be the case. So this, and again, to your point, the way you split up that initial piece of equity is going to have significant consequences on how, at exit, the wealth sharing is going to happen. So you do want to get it right, and I would encourage founders to use that tool or any other available tool to, and it's meant, for those who aren't familiar with slicing pie, it's meant to reflect, so when you first start a business and no one's really putting money in, or if they're putting money in, it's just a bit, it's more about time, reflecting the value of each individual's effort in a financial way on the founder shares. Yeah. Did I answer your question? Okay.
What was that resource, Slicing Pie? Is it online or in book form?
It's both.
It's called Slicing the Pie.
Yeah. He's got a copy of it there. So again, it focuses on how you split up that initial 100% equity piece before you've raised money, before you've taken on loans, just to really have the conversation with your co-founders and make sure everybody's comfortable with the amount of the pie that they get. Oh, careful.
None of what you presented actually showed anything to do with like how this connects in with, sizing your market, or what portion of the market you think you can, bring customers in from, and all of those assumptions. How does this connect with that?
Yeah, so you're talking about like sort of total addressable market, this stuff. This is more on the customer research side. So there's a lot of different points at which the finance function sort of bleeds into other functional areas, and sales and product dev is one of them. So when you're validating assumptions, when you're going out to talk to customers, when you're thinking about where these customers live, for my purposes, because that's outside of my expertise, I've sort of carved that into sales. Yeah, and they are numbers. And you do need them on your pitch deck, but it doesn't influence, this is on a much more tangible micro level, what's actually happening in the business, as opposed to what's happening in the broader world. Did I answer that?
So it's like an input to this.
Yeah. And you're never actually going to see it.
You see the results of it.
Exactly.
I'm just gonna ask another question.
Oh, we got one more up here. And then we got a guy back there too. We'll get to you.
I mean, is this on? I think it's on. It is green. It's on. Maybe my voice doesn't work. I guess I've never thought about things from this way, which I guess shows how naive I am, but it seems like you're just trying to build like a financial engine here.
Yeah.
And I mean, like an engine just does it. It's like, I'm not even sure how this is going to start. Like, it seems like it's starting in mid-process. I mean, it's starting from one spreadsheet.
Mm-hmm.
It seems like there's still pieces missing from how this would actually, like, move forward. Like, I'm not seeing how it starts from zero and actually gets into a running, operating, profitable, like, Because essentially investors are going to judge your company based on whether this thing could roll forward and grow or stay stagnant or actually just shrink and not even get going at all.
Yeah, hold on. I think I can answer your question. So this is really this is the sheet here, right? So you've got spending, which triggers sales, which costs you money to deliver. Then you need to cover your fixed expenses, and you get profit, which then goes back up. That makes sense?
So I guess there's two ways to fail. Is like either
there's
yours.
millions.
Yeah, all right, so there's at least two, right?
Yeah.
I mean, one is you make some incorrect assumptions or can't live up to those assumptions, and the other is you've started a company that actually can't make those numbers grow.
Yeah. Exactly. So part of why so much of the work is in the pre-revenue stage is because you want to answer those questions before you put a whole bunch of money in this, right? So there are business models, millions of them, that just don't work. Groupon is one. BP is another. I mean, these are like big companies make this mistake all the time. If the business model just doesn't work, then you don't put money into it. If the business model works, but only at the skinniest tail of probability distribution on your assumptions, you probably don't want to put money into it. So part of your job in the pre-revenue phase is to try to create a business model that is most resilient to changes in the assumptions, that gives you the widest berth for when the actuals are indeed different than the assumptions and can still succeed. Yeah. Yeah, but that's why, and that's you've hit on the exact point, which is what is the model of the business? What is the business model? How does money come in? How does it go out? What if it doesn't look quite like that? What happens to the business if this is off or if that is off? And there's a whole area of study around sensitivity analysis and scenario analysis where you can actually do that work and see what happens. Because you want to do it in advance as opposed to in the moment when you're in big trouble.
Thank you.
Yeah.
Yes, you talked about using spreadsheets to do all of this stuff.
Mm-hmm.
Would it make sense to also look into an inexpensive accounting package that you could use for prototyping your business to show, because it already has the form set up to do cash flow and accounts receivable, accounts payable, and that sort of thing.
I've never taken that approach, but there's no reason you couldn't.
To estimate the growth, you talked about looking at how much you're investing in, say, marketing and things like that. What other figures are you using to estimate that growth from, say, quarter to quarter? Yeah,
so in this case, I've just used sales and marketing just for simplicity's sake, but another one could be the sales funnel, right? So how many individual leads do you have? How many qualified leads do you have? How many pitch conversations do you have, and how many sales? So you can use a lot of different things to drive that revenue growth. When you get into models like SaaS and recurring revenue, those numbers will change again, and then you'll introduce churn and different things like that. But in this case, I've just used the simplest example, and that'll be more complicated with a complicated business model. Yeah.
I think I'm trying to remember now because you were talking about. So if we do this and we get, when do you figure out like it isn't gonna work and you need to just drop it?
Yeah. Oftentimes it'll be super obvious.
Okay. I didn't know if it was like, give it 6 months, give it 1 year, give it da-da-da.
Well, again, with the pre-revenue period of exploration, you really want to try to create models that both work and don't work.
Oh, before you even.
Before you even sell a thing.
Got it.
Just really understand what are the assumptions you're making, what is the range of potential outcomes around those assumptions, and what feels the most comfortable. So if in 99 cases out of 100.
Everyone's telling, like, everything I'm listening to nowadays, they're just like, go for it. People try to plan, and sometimes you just have to go for it because it will lead you in a different direction that might be profitable that you never even realized.
Yeah, I wouldn't do that, but.
I know.
Go for it.
I mean, I guess that's the difference between going with how you feel and realistic.
I'm very clearly on the
literal,
left brain or whatever that one.
And then this might not even be a question you can answer, but someone told me that I should maybe start with QuickBooks or something like that because I don't have an accountant and things like that. Okay.
Yeah. And that's one of the decisions you'll make as you come to market is which accounting system. And they're all great. Xero's good. QuickBooks is good. There's like plain text accounting if you're into computers and all this. I think we got a question in the back that's been very patient.
Yeah, quick question. As far as financing goes, What's your process for choosing whether to use debt or equity financing?
Mhm.
Is it like a personal preference, or are there some specific scenarios where one's more appropriate?
Yeah, it's usually about availability. So always choose debt if debt's available, because the consequences of having debt are much more nice than the consequences of having equity. So the rate's going to be lower. The terms are going to be very carefully delineated. The problem with debt is that, and I'm sure you've heard this, a loan is something the bank gives you when you prove to them that you don't need it. So debt financing is available only to a very narrow segment of the market. And when you get into SBA loans, it's a little bit different. But then with an SBA loan, you need to underwrite it with a personal guarantee. So I would say if debt's available to you in your business model, take debt. But for 99% of the cases probably in this room, it'll be equity.
Are you including convertible notes when you're saying debt?
Yes. Well, no, convertible notes are a form of equity. Yeah. They're equity masquerading as debt. Questions, comments? I answered everything. Good. Thank you, guys. Good luck.